So chapter 11 is related to chapter 10 in that we now understand to some degree how to value assets that we've purchased, how we want to treat them in different ways and through different means of acquisition. Now we have to talk about how we're going to allocate costs. We talked a lot about how, well, if we capitalize an expense, it doesn't actually get a sort of expense avoidance by being added to the value of the asset, because eventually it's going to have to be allocated through a process like depreciation, amortization, or depletion. So now this chapter is going to be devoted, the first part to depreciation, depletion, and amortization, the second part mostly to impairment. So why do we allocate costs? Remember that the matching principle is what tells me that I need to match depreciation expense to the periods in which the asset it is associated helps the company generate revenues. So it's always just going to be an application of the matching principle. It is not a fair value exercise, right? So we're not trying to value or obtain a market value for the assets by applying depreciation. We're simply rationally and systematically applying costs over what we call the service life of a fixed asset. We will sometimes want to have an estimate of the asset's fair value at the end of its useful life. So if we have that estimate of fair value at the end of the useful life, it's called residual or salvage value of the asset. But in practice, we don't typically see companies make any assumptions about the salvage value. So in the real world, most companies set their salvage to zero. And even if they have a salvage, it's not a required disclosure, and therefore it's a little hard to figure out in some cases. Methods of depreciation could seem arbitrary, right? We have a lot of different methods. We have accelerated methods, and some of the year's digits, we'll talk about them, a few of them. But again, it's all about having a systematic process and not necessarily a theoretically correct process. Depreciation is applied to plant and equipment. Amortization is applied to intangibles. Depletion is applied to natural resources. So again, these are just jargon and industry jargon for different types of depreciation. Again, we're obtaining a book value, not a fair value of assets by applying depreciation. And of course, I hope you know or have kind of gotten in your head by now that the book value is going to equal the acquisition or historical cost less the accumulated depreciation of the asset. It's going to be informative to investors just in the means of assessing a useful life of firm assets. So for example, if your assets have a book value that's nearing zero or at zero, that indicates that the company believes that it can no longer generate revenues from these items because they've lived out their useful life and have accumulated depreciation to the point that their value is near zero. Book value and fair value are certainly correlated for certain types of fixed assets, but we will not see that always, right? So for example, if an asset's no longer going to generate revenues from my company, its book value would be near zero because it's near the end of its useful life. It doesn't imply that that asset couldn't generate some sort of value for another business. Right? And I keep saying near zero. Of course, if you have a salvage value and that salvage value is an estimate of its fair value, then depreciation would be an exercise of taking the asset down to its fair value 10 years from now, 20 years from now. First, let's talk about the implausibility that you can actually accurately forecast a fair market value of most assets 5, 10, 15 years down the road, right? It's just going to be a sort of shot in the dark, right? So whether or not that's really going to be a good representation of the fair value, it's kind of arguable. But again, you just got to kind of let go of this idea that depreciation is in any way going toward a value that is a market value. And again, like I just said, that those residual or salvage values that we set as the fair value at the end of the depreciation schedule is just an estimate that we have to fact check. When we dispose of the asset, we will get a price for it. So when we actually sell it, that will be its fair value. We remove the asset's historical cost and accumulated depreciation. That would be its book value from our books. If we've used the entire, if we use the machine for the entire useful life, then at that point, historical cost minus accumulated depreciation will have equaled the salvage value, but that's just by mathematical construct, not by any sort of, oh, wonderful, we have the exact point estimate, right? No. It's just because when we set it up, that's what it'll solve to. Even if we fully depreciate the asset by using it in operations for the entirety of its life, the residual value at that point may not be equal to the fair value of the asset at that point. If the fair value is greater than the estimate, then we will recognize a gain on the disposal. And if our estimate of the residual value is above the actual fair value, then that means we're going to recognize a loss on the exchange. The effects of depreciation and amortization and depletion. For all of these, what's going to happen then is when we recognize any of these expenses, I'll just call them cost allocation expense, but that means it could be depreciation, depletion, or amortization. We are going to be reducing net income. Now, we're either going to be crediting accumulated depreciation or we're going to be crediting the asset directly. Either way, we're reducing assets. Now, when do we reduce the asset directly? Typically, we do that with amortization and depletion. We do not typically have contra accounts associated with amortization and depletion. So depreciation is really the only one that we have an accumulated account for, an accumulated contra asset for. Otherwise, if it's an intangible or if it's a natural resource, we just credit the asset directly. And that's just something in practice. It wouldn't be improper or against GAAP to do so. It's just, for whatever reason, it's typically not done. Measuring costs. Oh, one more thing. Depreciation, amortization, and depletion are non-cash or paper expenses, and they have no impact on the company's cash flow, right? The cash flow from any of these results from the acquisition of the asset, and that would be put into the cash flow from investing activities. So the acquisition of asset, the long-term assets that we've been talking about, result in a cash outflow to CFI. But when we start applying that cash outflow by recognizing an expense over the useful life of these items, we have to add back amortization, depreciation, and depletion to net income in determining our CFO. Because, right, whenever I make this entry, I'm not affecting cash, but I am decreasing my net income. So we have to correct net income for that bias when determining cash flow from operating activities. Measuring costs. This is just the vernacular surrounding the depreciation schedule. So we have to determine a service life, that is how long we're going to use it, also called a useful life. So those are interchangeable. An allocation base, which is just going to be the cost of the machine, the historical cost, the acquisition cost, less the salvage value. And then choose an allocation method to systematically apportion the allocation base over the service life. So the service life is the amount of time we expect to extract revenues from the asset before we dispose of it. For fixed assets, it's not necessarily their physical life. So, we might not be able to use it until it runs into the ground because there's some sort of an advance that makes this fixed asset no longer useful in our operations. For intangibles, it's not necessarily their legal life for a similar reason. We had a patent. That patent's good for 20 years typically. What if a new patent comes out? renders ours obsolete, then we no longer have something that has a useful life. Allocation base is just a function of the cost of the asset and our estimate of salvage value. Sometimes companies are going to use a salvage value of 0, and again, don't typically report, not sometimes, but oftentimes they use 0. And even if they have one, they don't report it if they're used. So you can kind of understand, A, the importance that companies put on this sort of estimation, and B, the importance that standard setters and regulators put on this sort of estimation. Because if they really felt it was crucial to know this stuff, if it was relevant to investor and creditor decisions, then they would force disclosure of these items. Allocation method is a choice among generally accepted accounting principles. These include time-based and activity-based models. I will cover 4 of them. There are more than that, just a smattering of different ones. There are tax-based allocation models, one's called makers. So, there's a variety of them. But as long as we are just spreading the expense over the period that something generates revenue, then we are within GAAP. So it doesn't have to be logical necessarily, it just has to do it systematically. So I'm going to use the same example for each method. And we're going to, I'll have to make an alteration for it for the activity-based method, but overall, we kind of do the same step process and use the same values and inputs to determine things. I'm going to say that we have a $450,000 machine with a useful service life of 5 years before we're going to dispose of it. That means that we're going to generate revenues for 5 years. That's our estimate. We estimate that we're going to have a salvage value of $100,000 at the end of that time. So remember, this is, again, the fair value estimate at the end of 5 years. Occam believes it'll produce 50,000 units from this machine during this time. That's going to be for the activity-based method. So let's look at straight line first. This is the one that you see the most. It is the most prevalent in practice. Constant expense allocation over time generates revenues equitably over the service life. That's just sort of the idea of if we were taking the matching concept literally, right? That's what I would assume. But it doesn't necessarily need to be the case. Again, we're just looking for systematic. It doesn't need to actually be true. But if theoretically, if we're taking a constant portion of expense over time, then that means that if we're literally following the matching principle, equal revenues are being generated over time. The formula is the cost, historical or acquisition, less the salvage divided by the number of years. So I take the cost, in this case, $450,000, subtract off my $100,000 estimate of salvage, which gives me an allocation base of $350,000, and then I divide it by its useful life of 5 years, which gives me $70,000 per year that I would recognize as depreciation. So here's just a schedule, right? Allocation base remains constant because it's a constant number. No matter what year we were in, we are allocating $350,000 as expense over the life of the asset. The rate is just the fact that we have 5 years. And to get the rate, it would just be 5 divided into 100 equals 20% per year. Depreciation expense is steady because we're talking about the straight line method. Accumulated depreciation builds at a steady rate. And the book value at the end of the year, again, is going to be just the historical cost minus accumulated depreciation. Notice that salvage value does not factor into the book value. The only way it'll factor in is that's your final estimate of book value, right? We're depreciating it down to its salvage value. And that's just, again, by mathematical construct, because I set the amount that I wanted to allocate at $350,000. So once it reaches $350,000, that's when the depreciation stops. An accelerated method can be used. when benefits are believed to be derived early in the asset's life. So again, this is just a literal interpretation of the matching principle. It doesn't need to be the case that you do this. You can apply accelerated method to whatever you want, even if you're going to generate 90% of the revenues in the first 2 years and 10% for the next 20. Okay. You can use straight line. But again, I'm just kind of trying to make you think theoretically, how does this apply, right? One accelerated method is called the sum of the year's digits. This is one that kind of looks arbitrary, but it doesn't matter. It applies a decreasing rate of depreciation to the asset over its useful life. So we're going to charge more depreciation in the first year, less in the second, less in the third, so on and so forth. How do we do this? We create a ratio of the remaining number of years in the asset's useful life and divide that by the sum of the year's digits in its total life. That seems pretty stupid and arbitrary, right? So for example, let's say we have a useful life of 3 years. I create ratios to express the rate in each year. In the first year, because I have a useful life of 3 years, I will have N, which is the number of years, divided by the sum of each year. So in this case, 3 plus 2 plus 1. So when I say the number of years, I should actually say, I'm trying to think, the number of years remaining in the useful life. So in the first year, it would be 3 over 3 plus 2 plus 1. So 3/6. In the second year, it would be 2 over 3 plus 2 plus 1. And the third year, it would be 1 over 3 plus 2 plus 1. So we are allocating a half, then a third, and then 12.5. Anyway. So 1/6 is, my math isn't working today, but it doesn't really matter. We're allocating a decreasing portion of the allocation base in each year. Right? So if we're doing, like, say, a 5-year, like in the Bevo example, we would have 5, 4, 3, 2, 1. This would be the first year, the second year, the third year, the fourth year, the fifth year. Remember, the number of years remaining. And then in the denominator, we have the sum of the year's digits, 5 plus 4 plus 3 plus 2 plus 1, right? So that would be 15. 5 plus 4 plus 3, 2 plus 2 plus 1 is 15. Why does this work? Because when we add all of these rates up, it equals 100%. 5 15ths, 4 15ths, 3 15ths, 2 15ths, 1 15th gives me 15 15ths, which means that I have now allocated 100% of the machine's allocation base. Again, just an arbitrary way of me getting a rate for each year that will sum up to having allocated 100% of this over the entire useful life, right? So 5 years, my allocation base is set. Again, that's the acquisition price minus the salvage. The rate is declining over each year. Depreciation is then calculated by taking the allocation base, multiplying it by the rate. That gives me the depreciation for the year, every year, and so on and so forth, all the way down. Then we have accumulated depreciation. That adds up. 116, 667 plus 93, 333 gives me 210. I figure out the book value by taking the historical cost of 450 minus the accumulated depreciation, right? Same process. The declining balance method is a little bit different. This is one that people will mess up just because it has a slightly different spin on it. We'll get to the spin when we get to the schedule. Or toward the schedule. But the first is just saying, well, what is a declining balance? The most common is what we call the double declining balance. The double declining balance applies a rate of 200% to a normal rate. So it assumes an advanced rate of depreciation. 150 and 125, so like the 1.5 declining balance or the 1.25 declining balance could be used, but again, the double declining balance is the one you're going to hear the most. So we apply this percent increase to what the standard straight line would be. For example, if we have a 5-year service life, we would depreciate 20% of its historical cost per year. That's under a straight line assumption. And again, I get that by just saying, well, if I have to allocate 100% of the allocation base, I have 5 years to do it, that's 20% per year, right? If we apply a double declining rate, the rate's going to be 20% times 200%, which is 2. So it would be 40%. A 10-year service life, right? If I had 10 years, then I'm taking 100 and dividing it by 10. 10% per year at a straight line basis, multiplied that by 200%, which is 2. The double declining rate would be 20%. Right? And again, we can do 150%, right? Just take the 5-year service life, that's 20%. 20% times 1.5, which is 150%, gives me 30% as the 1.5 declining balance, right? Go on and ad nauseum. The double declining balance, the big difference between it is that we do not take into account salvage value when determining any step in this process. So you throw that out the door, right? You don't have a cost allocation, you don't have an allocation base to apply the rate to. Notice that I start at 450 and apply a double declining rate, which was 100 divided by 5 equals 20 times 2. That's how I got that 40% there. I apply that rate to the book value at the beginning of the year. And remember, the book value ignores salvage value. So it's not going to be in this, which means if we don't have an allocation base, then we're not going to be getting a depreciation estimate that will take me down to salvage value. I don't have that end point anymore. And so I'm going to have to make a special consideration when I'm doing this, but we'll get to that in a second. First, apply the method. Book value times the rate gives me the amount of depreciation for the year. That's accumulated. Now, the book value at the end of the year, of course, is just going to be what its beginning of the year book value was, and what its historical cost was minus the accumulated depreciation that we have. That doesn't change. That gives me book value at the beginning of the next year. Multiply by 40% gives me the depreciation for the next year. I add that depreciation to what's been accumulated the prior year. I have accumulated now. I take the accumulated, subtract it from the historical cost, get the book value at the end of the year. I take it to the beginning of the year, multiply by 40%. Use this depreciation. Oh, wait a minute, right? When I multiply this by 40%, it's going to give me depreciation that if I accumulated will take me below the salvage value. So what happens here? What's going to happen at this point then is companies are going to have to switch methods. They'll do one of two things. They'll either switch methods or they'll just take the remaining depreciation to bring it down to salvage in the third year. Okay. Now, if you do that, the problem is it's only 3 useful years. Right? Depending on how material it is, then you can use the first method. Right? But it changes the service life. So that's not really preferred. What is more preferred is switching allocation methods at this point in time. You would say, all right, I have 62,000. I need to spread this over 3 more years. How am I going to do that? Well, I'll switch to, say, straight line. In that case, that means that I have a new book value of 162,000. I want to get it down to a salvage of 100,000. That means I have an allocation base of 62. I divide that by 3 years, and that gives me $20,667 per year. And then I could use that as my remaining schedule of depreciation being charged on this item. So a lot of times, if you do an accelerated method, you have to switch to the straight line method in order to get it down to salvage. The activity-based method uses inputs or outputs to determine expense, doesn't matter which. I will typically phrase it in terms of outputs, like we think we have 50,000 units that we can produce from this item. Well, what I do then is divide 50,000 units into the allocation base, and I get $7 per unit produced. Once I have that, what I then need is a schedule of how much units I've produced every year. This is like the most literal interpretation of the matching principle there could be, or perhaps the most accurate, not the literal, because you can literally apply it in a lot of different ways depending on the production. But this would be a very fact-checked way of matching, because now you have the number of units you've actually produced at the rate per unit, that equals depreciation. That accumulated depreciation and book value. This is similar to the other ones. We're using salvage to determine the allocation base. Once we have the allocation base, we get the rate per unit, and then we will use up, hopefully, all of that. Now, for example, suppose that our number of units that we thought we would record is slightly off. So in this case, I have 11, 7, 12, that's 30, 40, 48. So I have 48,000 units produced. Notice that this next estimate of depreciation won't bring me all the way down to book value at the end of the year, because I didn't produce the 50 that I thought I was going to get from it. So this always happens with an estimate. And then you just got to, apply whatever you feel is appropriate at that point. If it's material, if it's not material, we'll discuss different things of how and what to do when estimates do not necessarily pan out. But in this case, of course, the accumulated depreciation would become 280 plus 56, that's 336. And then when we subtract that from the book value, that would result in 114. I haven't had enough coffee this morning to have my mathematical calculator on board. But anyway, I'm sorry, my mental calculator, not my mathematical. Anyway, so that is how we would work with an activity-based method, right? Any questions about that? I hope you bring questions. Don't be afraid to ask them. They are formulaic, but again, I find that people really screw up the accelerated double declining sort of rates because they forget about the salvage issue. But work through these, make sure you know them. A lot of times I don't know why intro classes emphasize these so damn much, because so many people use straight line. It is important that you know each of them. You could be tested over them in my class, and you could be tested over them in the CPA exam. So choice of depreciation methods, again, theoretically, not literally, but theoretically, we should match the greatest expense to the most useful or productive periods of the asset's life. So the units of production produces the most logical mapping of expenses to revenues, because when we run the machine into the ground and produce a ton of units, we're going to have the most expense, right? However, most companies will use straight line. Accelerated methods are going to recognize more expenses in the short run, lower net income in the current period, but then less expense in future periods, hence greater net income in future periods. We're going to get into this with deferred taxes, but a lot of companies will choose straight line for their books and accelerated methods for tax purposes, because you want to save more money today, because that tax purpose money, or that taxable income that you report on your tax returns, is cash, and you want that cash today. The net income, it doesn't really matter, right? It's an accrual-based number, so there's less of an emphasis on that. Regardless of the choice of methods, it doesn't alter total retained earnings. I kind of throw this out there. It's not so clear what's going on without having it in color, but on your notes on the document, it would be in color. Straight the allocation per year will be different of depreciation expense. So the straight line. This is the straight line because it's as constant over time. The sum of the year's digits is going to apply a more expense in the first year than in the final years, but it's going to be a little more systematic in how it declines over time than will be the double declining balance. So this is the sum of the year's digits. The double declining balance is going to be a lot in the first, a little bit less in the second, and then less, and then it kind of goes down into straight line after it's reached a certain point because we switch over to straight line. That would be the double declining balance method. And then the units are going to be all, activity is going to be all over the place depending on what's going on. It pans out into the straight line, so you don't see what it does at the end there, but that's the units of production. Okay. Now, that's all over the place in terms of the depreciation expense they charge, but notice, right, that they all come up to the same amount of total expenses charged, and that is just the allocation base. So the allocation base sets the total depreciation expense recognized. Right? They're all going to end up at 350 because we have the same allocation base. They're going to get there at different rates, but they'll get there eventually at the same time in 5 years. Right? I'm going to stop there, and I'll split up the videos so that group and deposit methods of depreciation are on a different video, and we will talk more about that in a bit.